What if the seemingly random ups and downs on your trading charts aren't random at all? What if they're actually a meticulously orchestrated dance by unseen forces,
Mm-hmm.
where, every dip and surge actually serves a larger hidden purpose?
Exactly.
Today, we're pulling back the curtain on the financial markets, specifically Forex, as we dive deep into a really powerful source, the ICT handbook PDF.
Yeah, this isn't just about standard technical analysis.
No, it feels like it's about fundamentally reshaping your perspective,
Okay.
focusing on the real drivers, smart money, and this hunt for liquidity.
This deep dive is truly about gaining a profound understanding of how financial markets actually operate behind the surface movements.
Right?
We're aiming to go beyond what most retail traders typically see, revealing the why behind the what.
Giving you a shortcut, maybe, to understanding the market's hidden language.
Precisely.
So, okay, to crack this code, we have to ask some, let's say, fundamental questions that really challenge conventional wisdom. Like, what are these core principles of market movement that most traders seem to completely miss?
That's a big one.
And are powerful institutions, these smart money entities, are they truly manipulating prices? And if they are, what kind of, shocking implications does that have for individual traders like you?
It's a crucial question.
And ultimately, can these insights actually help you spot powerful trading opportunities where, others just see noise?
That's the goal, isn't it? To find clarity in the chaos.
Let's begin decoding then. Okay, let's start by recognizing the market's most basic rhythm. It's very breath. Expansion and retracement.
Yeah, the absolute fundamentals.
Most traders, I think, intuitively get that price moves up and down. But here, we're defining expansion very specifically as that powerful impulse movement, right? That clear, strong push in one direction.
Exactly. The forceful move.
And then the retracement is the market catching its breath, the correction that follows. You could almost think of it like E for expansion, that big push.
And R for retracement, the pullback.
Like the momentary pullback.
And these two movements are the fundamental building blocks. In an uptrend, you'll see a clear progression. Higher highs followed by higher lows.
Mm-hmm.
Each higher low is that retracement, which then fuels the next expansion.
And the opposite in a downtrend, lower lows, lower highs.
Precisely the inverse. It's this continuous ebb and flow, but framing it as expansion and retracement really highlights the underlying intent of the price move.
And here's where it gets really interesting, I think, because the market doesn't just retrace randomly, does it?
Not usually, no. There's often a method to it.
So how do you know when a retracement is likely to end? How do you anticipate that next powerful expansion kicking off?
Well, this is where Fibonacci retracement, but applied with let's say, a specific lens, comes into play.
Okay.
Fibonacci isn't just about drawing lines at random levels. It's actually a pretty powerful tool for pinpointing potential reversal points within that retracement.
So not just the standard levels.
Well, the 50% mark is always significant, yeah. But what's truly fascinating in context are the optimal trade entry, or OTE levels.
OT.
That's the 0.62, the 0.705, and the 0.79 levels. These aren't just arbitrary numbers. They represent these precise pockets where smart money often allows price to pull back to.
So they're letting it come back to these specific points?
It seems that way. They offer highly probable reversal points before the next big impulse move kicks in.
Yeah.
It's almost like the market is efficiently repricing itself before continuing in its true direction.
Okay, so we've seen how price breathes, expands, and retraces, and how it pulls back strategically, potentially to these OTE levels. But if we're trying to understand the market's true intent, what signals a fundamental shift in that breath, like a change in the overall direction?
That leads us directly to the concept of a break-in market structure, or BMS.
BMS, got it.
A BMS happens when the price makes a clear, undeniable close above a significant swing high in an uptrend.
Or below a swing low in a downtrend.
Exactly. Below a swing low. This is absolutely critical for understanding the market's overall trend direction. You really need to pay attention to this, especially when you're looking at the higher time frames.
Right. The bigger picture dictates the flow.
Absolutely. And the golden rule here is pretty clear.
Mm-hmm.
You should always aim to trade in the direction of the higher time frame BMS.
Okay, trade with the HDF BMS.
But, and this is a crucial insight, after a BMS occurs, you have to resist that urge to just jump straight in.
Don't chase it.
Don't chase it. Always. Always wait for a retracement after the BMS. Let the market come back to you.
That's a powerful distinction. So when a BMS happens, it's not just signaling a potential trend change, it often marks the establishment of a whole new consolidation range. It defines a new range high and range low.
Precisely. The BMS basically resets the playing field. It establishes a new set of expectations for where price might go.
Okay.
And interestingly, even before you get that full confirmed BMS, there's often an early, maybe more subtle warning sign that could give you an edge.
Right, you mentioned the failure swing, or SMS. How does that work? How does it act as a kind of pre-BMS indicator?
So a failure swing, the SMS, happens when, let's say in an uptrend, the price tries to break a previous swing high,
Right.
but it fails to do so convincingly. Doesn't make a strong new high.
Okay, it stalls out.
It stalls out.
Mm.
Then, critically, it turns around and proceeds to break the prior swing low.
Ah, okay. Fails high, then breaks the previous low.
Exactly. It's a subtle but really significant shift. It shows weakness in the existing trend before you get that full market structure break. Think of it as an important early alert that a reversal might be setting up.
A sneak peek into the market's changing intentions.
You could say that, yeah.
Now, let's get into the real engine of these markets. And this, I think, is where things might get a bit unsettling for some listeners because it really challenges what you thought you knew.
It often does.
We're talking about liquidity in this, well, enigmatic force known as smart money. The Forex market, at its absolute core, it's a zero-sum game, isn't it?
Absolutely. 100%. For every single buyer, there has to be a seller. For every winner, there's a loser.
And this is where smart money, we're talking the major banks, the big institutional giants, this is where they enter the stage.
Right. They operate with absolutely colossal trading volumes. Orders so large they can move markets.
Yeah.
And to place those massive positions, they need an equally vast amount of opposing orders, which is liquidity.
They need someone to take the other side of their huge trades.
Exactly. And what's truly fascinating, and maybe a bit revealing or even disturbing depending on how you look at it,
Go on.
is that the very existence of stop losses placed by individual retail traders, like you listening now, often creates the precise liquidity that smart money needs to fill their gargantuan orders.
Wow. So our stops become their entry fuel.
In many cases, yes. Banks and institutions often manipulate the price specifically because they need that liquidity. They need to trigger those existing stop losses, both buy stops and sell stops, to get their own trades filled at the prices they want.
It's almost like they're intentionally flushing out the small fish to feed their whales. That sounds manipulative.
Well, the source calls it manipulation. They need liquidity, and stop orders represent readily available liquidity sitting there on the charts.
So this crucial liquidity they're hunting for, it basically comes in two forms, right? Like a double-edged sword.
That's right.
You've got buy stops liquidity, or BSL, that's generated by the stop losses sitting above highs from people who are short.
Correct. Stop losses on sell orders.
And then sell stops liquidity, SSL, which comes from the stop losses below lows from people who are long.
Exactly. Stop losses on buy orders. It really is the market's hidden fuel.
So where do they look for this fuel? Where do they target?
Okay, so for BSL, the buy stops liquidity, smart money strategically targets areas where sell orders are likely to have clustered their stops. Think about obvious highs, previous month highs, previous week highs, previous day highs, maybe the highs of the current day.
Or those equal highs everyone sees as resistance?
Precisely. Those clean equal highs that scream resistance to retail traders are often prime targets for BSL sweeps. Once this BSL is taken, grabbed, the market typically reverses quite sharply to the downside.
And the flip side for SSL.
Conversely, for SSL, sell stops liquidity, they focus on areas below obvious lows where buy orders likely have their stops placed. So previous month lows, week lows, day lows, the lows of the current day.
And those equal lows that look like super strong support.
Exactly the same idea. Those tempting equal lows that look like rock-solid support are often magnets for SSL hunts. After the SSL is taken, the market tends to reverse dramatically, often very quickly to the upside. It's a sophisticated liquidity grab targeting obvious areas.
This is where it gets truly eye-opening, maybe even a bit shocking for some. The concept of the stop hunt. What exactly is this? How does it play into the manipulation we're discussing?
A stop hunt, or SH, is essentially a deliberate price movement engineered by market makers, the banks.
Yeah.
It often looks like a false breakout. And it's explicitly designed to neutralize liquidity by triggering clusters of stop losses. It is a calculated move specifically to activate those pending stop orders because that provides the necessary volume for their own large positions.
So when you see price aggressively push above what looks like super strong resistance, only to just collapse back down spectacularly.
Or dip convincingly below what seemed like solid support, tricking people into selling the breakout before bouncing back with real force.
That's probably a stop hunt.
You are almost certainly witnessing a stop hunt in action. This is the core mechanism where banks, the smart money players, manipulate the price because they need to activate those stops to fill their massive orders efficiently.
Yeah.
It's absolutely not random noise, it's strategic deception.
Wow. Okay. So if these smart money players are orchestrating these stop hunts, is there a specific catalyst or maybe a certain time or event they often leverage to execute them most effectively?
Oh, they absolutely have a favorite tool for this. Market makers, the banks, usually utilize high-impact news events to take liquidity.
Ah, the news.
Yes. Think major economic reports, central bank announcements, interest rate decisions. These kinds of events create the surge in volatility and market frenzy that's necessary to sweep those stop losses quickly and efficiently.
And maybe without drawing too much suspicion, because everyone blames the news for the crazy move.
Exactly. It provides cover. This is why paying close attention to the economic news calendar isn't just about reacting to the data release. It's about anticipating when smart money might be poised to make a significant move, often disguised within that news volatility.
That makes a lot of sense. You know, speaking of navigating the markets, it's really important to use reliable platforms. Because of the prevalence of scam trading platforms out there, ones that are far removed from genuine trading and investment, we've actually found a secure and global platform we trust.
Yeah, finding a good broker is critical.
It's considered one of the best investment platforms around, allowing you to trade in the stock market, gold, currency pairs, Forex, and many other markets too. It's incredibly fast for deposits and withdrawals, which is a big plus. And get this, you'll get a 50% bonus on your first deposit. We've put the link for that platform below in the video description for you to check out.
Good recommendation.
Okay, so if the market is being manipulated by these big players, and they're clearly pretty good at hiding their intentions within volatility and news, how do we spot where they've been active? How can we possibly find their, digital footprints on the chart?
That is the million-dollar question, isn't it? And that's precisely where order blocks, or OBs, come in.
Order blocks, okay.
Think of order blocks as maybe the scene of the crime left behind by smart money. They are specific candles, or sometimes a small group of candles, where market makers have demonstrably placed their colossal positions.
Right, where they initiated their moves.
Exactly. And because those large orders were placed there, these areas then act as incredibly strong potential price reversal points when price returns to them later.
So the market kind of remembers those levels.
That's the core concept. The idea is profound. Once the price revisits one of these order blocks, it should theoretically hold a significant support or resistance, assuming it's a truly valid order block, of course. This is because those large institutional orders are potentially still active or defended there.
Okay, so what exactly do these powerful order blocks look like on a chart? How do we distinguish them? Are they just any candle?
No, not just any candle. There are specific definitions. A bullish order block is typically defined as the last down close candle, the last bearish candle, before a significant, powerful bullish move.
The expansion we talked about earlier.
Exactly, the expansion move, a bullish move that results in a clear break in market structure, BMS, to the upside.
Okay, last down candle before the up move and the BMS.
Right. That specific candle represents a high probability area where, if price retraces back down into it, it should find strong support and potentially continue higher.
And the opposite for bearish.
Precisely. A bearish order block is the last up-close candle, the last bullish candle, before a powerful bearish expansion move that breaks market structure lower, a bearish BMS.
Got it. Last up candle before the drop and the BMS.
Correct. If price rallies back up into this bearish order block, it's expected to encounter significant resistance and potentially continue its downward trend. They really are like the market's memory of where the big money step in.
Okay, that's fascinating. Let's zoom out a bit now to the daily market rhythm. How do the different trading sessions, Asian, London, New York, how do they impact this whole elaborate dance of liquidity and manipulation we've been discussing? What's the daily pulse?
Yeah, understanding the daily cycle is key. The overall daily range is fundamentally defined by its open price, its low, its high, and its eventual close price.
Simple enough.
OHLC.
Right. But within that daily landscape, there are three key sessions that really dictate much of the price action and the strategic moves of smart money throughout the day.
The Asian session, London session, and New York session.
Those are the main ones, yes. And each session really seems to have its own distinct character, doesn't it? Almost like different acts in a play unfolding each day.
That's a great analogy. It really is like a three-act play sometimes. The Asian session, typically running from around, say, 02.0 to 08.000 UTC plus 2, is generally characterized by consolidation.
Low volatility, tight range.
Usually, yes. Often a tight range, maybe 20 to 40 pips, mainly due to a relative lack of major market participation and liquidity during those hours. It largely serves to set the stage.
How so?
It defines an initial range, an accumulation zone, that often becomes critically important later in the day for manipulation.
Ah, so the range built in Asia gets targeted later.
Frequently. Then the London session, kicking off around 09.00 UTC plus 2, is often where the real action begins to unfold. This session frequently establishes either the high or the low of the entire trading day.
Okay.
And it can be strategically used by market makers to trap traders against the true intended daily direction, often by engineering a sweep of liquidity that built up during the Asian session.
But a false move at the open.
Very common. The first 2 or 3 hours of the London Open are particularly potent times to watch for these kinds of manipulative moves.
And then New York comes in to wrap things up or shake things up again.
Yeah, the New York session, starting around 14.0 UTC plus 2,
Yeah.
often presents initially as a kind of retraction or pullback after London has potentially established a significant higher low.
A correction of the London move.
Sometimes. However, New York can also be the session that ultimately sets the definitive low or high of the day itself, sometimes reversing the London move entirely. Again, those first 2 to 3 hours of the New York Open are generally the most active and insightful for spotting key moves.
Okay, this is starting to paint a picture. This daily cycle brings us to a really critical market narrative, one that seems to tie all these things together, the daily movements, the session characteristics, the smart money actions. It's like a three-act play, as you said, unfolding almost every single day. Accumulation, manipulation, and distribution. AMD.
AMD. It's an excellent framework for conceptualizing the daily price flow. Think of it like this. Accumulation is the quiet initial phase. This is where market makers are often silently gathering their large positions, building their inventory. This frequently happens during periods of low volatility consolidation, like the Asian session.
Okay, loading up quietly.
Like they're loading their heavy artillery without making much noise. Then comes the crucial, often deceptive second act, the manipulation phase.
The trap.
Exactly.
Yeah.
This usually occurs around the volatile opening periods like the London Open or sometimes the New York Open. Here, the price is deliberately engineered to break the established range, often pushing to the opposite side of the true intended direction for the day.
Why?
This is where smart money actively uses that buy stops liquidity, BSL, or sell stops liquidity, SSL. We talked about rating the stops above the Asian high or below the Asian low, for instance, to fill their massive orders while simultaneously tricking retail traders.
Getting them to chase the breakout in the wrong direction.
Precisely. They set the trap, inducing traders to buy the false breakout high or sell the false breakdown low.
And then finally, the third act, the payoff for smart money.
The distribution phase. This is when the market makers begin to unwind or liquidate or exit their accumulated positions. And as they do, the price then moves powerfully in the true, originally intended direction, often moving sharply against that earlier manipulative move.
So the real move happens after the fake out.
Often, yes. Understanding this three-phase AMD narrative accumulation, manipulation, distribution is absolutely key to anticipating where the market is likely headed next, not just reacting to where it's been. It helps reveal the deliberate process behind what often looks like market chaos.
That framework, AMD, is incredibly powerful. Understanding these concepts truly is a game changer. It shifts your whole perspective.
It really can.
And if you're listening and feeling ready to dive even deeper, to really learn how to master trading and investing from scratch using principles like these, we highly recommend checking out a professional course that breaks all this down in detail.
Yes, structured learning can make a huge difference.
We've put a link for a course we recommend in the description below the video too. Definitely worth exploring if you're serious about this.
Cool.
Okay, so we understand the language, the market structure basics. We understand the players, the smart money, and their hunt for liquidity. We see the daily AMD cycle. How do we put this all into practice? how do we actually use this knowledge to identify powerful, high-probability trading opportunities? What are the specific setups?
Right, the practical application. Well, these insights lead to very specific and, when correctly identified, high probability trade setups that aim to capitalize on these smart money movements, not fight them.
Okay, lay 'em on us.
First off, there's turtle soup, which interestingly is essentially just another name for a stop hunt, viewed as a specific entry pattern.
Ah, the stop hunt again.
Yep, it's that false breakout, specifically designed to sweep liquidity. So a turtle soup short setup occurs when buy stops liquidity, BSL, is rated above an obvious resistance point or high.
The price spikes up, grabs the stops.
Exactly. And then you look for indications it's about to reverse strongly downwards. That's your sell setup. Conversely, a turtle soup long is when sell stops liquidity, SSL, is swept below an obvious support level or low.
Price dives down, takes out the stops.
Right. And then you anticipate a strong reversal back up. That's your buy setup. The key is you're entering against that initial liquidity sweep, aiming to catch the reversal as the market reveals its true hand after the manipulation.
Fading the false move, essentially.
In a way, yes, fading the manipulative move. Then there's a really powerful sequence that combines several of these concepts. It's often considered a very high probability setup, SH plus BMS plus RTO.
Okay, break that down. SH, BMS, RTO.
It stands for stop hunt, SH, followed by a break in market structure, BMS, followed by a return to order block, RTO. It's a highly reliable sequential setup.
So step by step.
Step 1. First, you identify the stop hunt, that deliberate liquidity sweep, the false move we just discussed.
Okay, see the manipulation.
Step 2. You then need patience. You wait for a clear break in market structure, BMS, in the opposite direction of the stop hunt. This BMS undeniably confirms that the stop hunt was likely manipulative and signals the market's new intended direction.
Got it. Confirmation.
Step 3. After that confirming BMS, the price will often, not always, but often retrace back. It will return to the order block, RTO, that was formed just before or during the initiation of the move that caused the BMS.
Ah, back to that scene of the crime.
Exactly. That return to order block, the RTO, becomes your precise high-confidence entry point. You are, in essence, waiting for confirmation and then catching a ride on the coattails of smart money as they potentially defend that level.
That sounds incredibly robust. Stop hunt first, then the confirmation break, then the pullback entry.
When all three align, it's a very strong pattern according to this methodology.
Is there a similar setup that maybe uses that early warning sign, the failure swing, instead of a full stop hunt?
Yes, absolutely. There's the SMS plus BMS plus RTO setup.
Failure swing, break in market structure, return to order block.
Correct. This setup starts by identifying an SMS, a failure swing, which first indicates that potential trend weakness or impending reversal we talked about earlier.
The early warning.
Right. Once you see that weakness hinted at by the SMS, you then look for the subsequent BMS, the confirming break in market structure, which solidifies the new intended direction.
Okay.
And finally, just like with the SH plus BMS plus RTO setup, you patiently wait for the price to return to the relevant order block created during that process. That RTO provides your precise entry point. It's another excellent way to try and align your trades with the institutional flow, but perhaps catching it slightly earlier sometimes.
Okay, that makes sense. And how do we actively trade the whole AMD narrative itself? Accumulation, manipulation, distribution. Is there a specific setup for that?
Yes, the AMD trade setup essentially involves recognizing and acting upon these distinct phases as they unfold, typically on an intraday basis. During the accumulation phase, often the Asian session, you're mostly observing, watching the market consolidate and define a range.
Patience is key.
Very much so. Then, during the manipulation phase, maybe London open, maybe New York open, you watch for the price to break that established range, specifically to trap unsuspecting traders by taking out the BSL or SSL. You don't trade this manipulation.
You watch for the trap, you don't fall into it.
Exactly. The key is to wait for the third act, the distribution phase. This is where the market makers are likely liquidating their positions accumulated earlier, and the price finally starts to move strongly in the true direction they intended all along, away from the manipulation level.
Okay, so you trade the real move.
You look for entry opportunities during this distribution phase. These entries often take the form of simple RTOs, returns to order blocks created during the manipulation or starter distribution, or you might find a clearer SH plus BMS plus RTO or SMS plus BMS plus RTO setup unfolding within that distribution leg. It's all about being patient, identifying the manipulation, and then looking to enter when the market shows its true hand.
Wow, okay. It really emphasizes that this isn't about relying on just one single indicator or signal, is it? It's about combining multiple confirming factors.
Absolutely. Which brings us directly to the powerful concept of confluence.
Confluence, stacking the odds in your favor.
Precisely. Confluence is incredibly important in this approach for significantly increasing your trade probability and, just as importantly, your confidence in taking the trade. It simply means having at least two, ideally more, independent factors aligning to support your trade idea.
Can you give some examples of these confluence factors?
Sure. Factors of confluence could include having strong, higher time frame analysis backing your directional bias, timing your entries specifically during the high volatility periods like the London or New York Open kill zones, refining those key higher time frame levels like HGF order blocks or liquidity pools down into precise lower time frame entries, maybe combining several of these powerful setups we've discussed, like seeing an order block confluence with an OTE level, or even strategically planning trades around high-impact news events if your analysis aligns.
The more things lining up.
The higher your potential probability and the greater your conviction in the trade idea should be. It's about building a strong case for entry.
It really is like looking at that strategic big picture map first, and then drilling down to the street view to find the exact turn, the perfect entry point.
That's a perfect analogy. Higher time frame, HTF analysis, it's absolutely fundamental. You use it to identify the major key levels, the significant HTF order blocks, the obvious HTF liquidity pools where stops are likely resting, and the overall HTF market structure, the main trend.
Getting your bearings first.
Exactly. Once you have that big picture, that overarching strategic direction from the HTF, you then drill down and use the lower time frames, LTF, for precise entry timing, risk management, and trade confirmations.
Finding the tactical entry within the strategic framework.
Precisely. For example, as the source suggests, a swing trader might use the weekly, daily, or maybe the H4 chart for their HTF directional bias and key levels. Then they might refine their entries on the H1, M30, or even M15 chart, looking for those specific setups like RTO or BMS.
And for shorter-term traders.
Day traders or scalpers might use, say, the H4, H1, or M30 as their higher time frame context, and then execute their trades based on signals on the M15, M5, or maybe even the M1 chart. It's all about aligning your tactical, lower time frame entries with the larger strategic institutional flow indicated on the higher time frames.
Okay. We have covered a lot of ground today. We've taken a truly deep dive into how this smart money perspective suggests the markets operate, and crucially, how you might begin to spot their hidden footprints on the charts. We started with that foundational language: expansion and retracement, the strategic use of Fibonacci OTE levels, understanding break in market structure, and that early warning sign, the failure swing.
The building blocks.
Then we really dove into the invisible hand of liquidity, the, well, unsettling purpose behind stop hunts, and how high-impact news is often used as a catalyst for these manipulative moves.
The engine room, so to speak.
And finally, we explored how to actually read these footprints through powerful order blocks and understanding the daily price cycles of accumulation, manipulation, and distribution, which led us into identifying powerful setups like turtle soup and that high-confidence SH plus BMS plus RTO sequence.
Putting it all together into actionable strategies.
It really paints a picture of a market driven by deliberate actions, not just randomness.
And remember that core idea we discussed. The market hardly ever makes a significant reversal without first taking liquidity from somewhere, sweeping highs or lows.
Right.
This strongly suggests that what often looks like just random volatility or chaotic market movements is, in reality, frequently a very deliberate action, orchestrated by these powerful players to facilitate their own business.
So a final thought to leave our listeners with.
What is that fundamental truth that liquidity is often taken before major turns? What does that imply for how you approach not just trading, but maybe how you analyze and understand any complex system you encounter in your life where hidden incentives might be at play?
That's a deep one. And it leads to some challenging questions for you, the listener, to really ponder. First, how might your current understanding of market movements fundamentally shift, knowing now or considering the possibility that liquidity is often the primary driving force behind what appears to be market manipulation?
How does that change your chart reading?
Second, if banks or large institutions are actively orchestrating price movements to hunt liquidity, what new strategies could you possibly explore to try and align with rather than inadvertently fight against their actions?
Can you ride their waves instead of being drowned by them?
And third, thinking broader. Beyond the world of trading, where else in your life, maybe in business, negotiations, even social dynamics, might understanding these underlying patterns of accumulation, manipulation, and distribution help you identify hidden dynamics or perhaps anticipate outcomes more effectively?
Interesting parallels to consider.
It's definitely food for thought. Now, if there's a specific topic you would like us to deep dive into in a future session, something that's always puzzled you about the markets or finance, please write it down in the comments below. We do read them.
Yeah, let us know what you're curious about.
And also remember, there are several important links in the description below this video, including the trading platform and the course we mentioned. We really do recommend checking them out for further exploration and resources.
Definitely worth a look.
You know, this deep dive today certainly builds on some of our previous discussions, particularly around the human element in finance.
The psychology aspect.
Exactly, how psychological biases that affect retail traders can play right into these smart money manipulations we've discussed. Things like fear of missing out or chasing price.
Classic mistakes that provide liquidity. We touched on some of that before, didn't we?
We did. So if you found this deep dive valuable today and you want more insights like this, don't forget to subscribe to the channel. We've got more mind-bending deep dives coming your way.
Hit that subscribe button.
And as always, the links to the handbook that inspired this discussion and the other resources are waiting for you below. Next time, we'll be exploring something really interesting. How these very same principles of liquidity, manipulation, and smart money concepts might apply across different asset classes. Is it just Forex, or do we see similar things in stocks, commodities, maybe even crypto?
Yeah, exploring the universality of these concepts should be fascinating. Looking forward to that one.
Me too. Thanks for tuning in.